right, this is my strategy part 2. So if you are just seeing this video without part 1, please go back and watch part 1 first so everything to make sense. So where we left off at is pivot points, talking about how I use pivot points in my trading. So this is another area where I'm trying to look for areas of reversal or areas where the market is going to stall out. These pivot points definitely help with that. They don't always work, but they do work a lot of the time. And if you use that in conjunction with something like stochastics, other people use MACD, other people use RSI, whatever works for you. Use that in conjunction with your pivot points and areas of support and resistance, which I've talked about on other videos. And you use that with your knowledge of price action, measured moves, higher highs, lower lows, stuff like that. Then you're going to be able to make very reasonable guesses and assumptions about what the market is likely to do next and find very good spots for your trading. All right. So lastly, what I want to talk about here is a less than successful day where I actually did have to exit the trade, which was February 9th. Now, a day like February 9th is an absolute nightmare for spread traders. February 9th is a day where the market just trended in one direction all day long. Okay, so here we go right here, and you can actually see my adjustments and everything like that. A day like today, if you pick the wrong side of the market, there's just nothing that you can do, right? You're just gonna have to get out the trade. You're just gonna have to exit and take it as an L. So this day, I wanted to be on the put side of the market. I wanted to be on the underside of the market here. So I decided that this was a good entry point right here. Went ahead and entered the trade. And honestly, there just was no good point. And I'll say this, 99% of the days in the market don't look like this. Almost all days in the market, they're going to be some sort of reversal during the day, some sort of, okay, the market's finished going in this particular direction and then it reverses and goes in another direction. This is the 1%, right? So there just was no good entry point on the put side today. I don't know what made me want to focus on the put side today, but I did. Okay, probably should have done the call, but you do what you can do. So I entered probably midday, something like that, into a put that I thought had plenty of room. This put had, how much space is that? About 41 points, which isn't honestly that much, but it was below S2, which probably made me feel comfortable in the trade. We were well above S2 at that point. We have a gap fill opportunity right here at this level. You can see that the market gapped up and then it closed the gap. So usually when it closes the gap, it's anyone's call as to what the market's going to do. It usually stabilizes and, kind of plays around a little bit. But today, it just didn't care. It just kept going down and down, 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 down. Now, this is what I call a royal flush. Okay, so it's just in one direction and that's it. Okay, so you can't win if you're on the wrong side of this market. And I'll show you that. So I've already pulled up February 9th on this particular chart right here. So this is a very useful website, 0DTESPX.com, especially for SPX day traders. And what the significance of this particular website does is it tracks the market live, but it tracks several different things at one time. It's just going to track your volatility, your VIX. It's going to track your expected move, which is how I trade. I trade at 2 times the expected move, which is also like saying that I trade at 2 standard deviations above and below wherever the market happens to be at that time. And you can see the standard deviation lines on this chart. So if you look at the green squiggly lines, you have a lighter green squiggly line that's back there. You have a darker squiggly line. These are 1 and 2 standard deviations above where the market is at that particular time. And then at the bottom, you can see a red squiggly line and a lighter red squiggly line. These are 2 standard deviations below the market. So where I like to trade is I like to trade at and above right above the second standard deviation above and below where the market is. And you can kind of see as the day goes on how the standard deviation lines close in on the market, which is this blue line in the middle. This is the actual market pricing. And when we start out, the standard deviation lines are pretty wide, but they close in as the market comes to a close to come right and join exactly where the market is at the close. So this basically represents our time value, our time premium shrinking as the day goes on, which is what we want. This is why we trade spreads, right? So as these lines close in towards the market and we're away from the market, this represents our profitability, so to speak, right? So today you could see what we don't want as spread traders, and we're trading like I do not want the blue line to cross over where this light red line is at any point during the day, right? That's what I want. And usually that's what happens. That's why it's two standard deviations. That means the market has a 95% chance of not crossing this light red line at any point during the day. But what you can see, the low of the day, I don't know if you can see that, but the low of the day was 40.69. So right here where this line is, 40.69. And you can see that the market gets lower than where this standard deviation line is. So this standard deviation line is right here. Later on in the day, the market actually eclipses where that standard deviation line is. So if I place a trade up here, it's right at the open at what is that? That is 40.97. So if I place a trade right at 40.97, then the market would have blown through my strike. If I waited in the day and tried to trade, say this is 40.78, let me get this back so you can see it. 40.78 or something like that. I waited for this dip right here. I still would have been blown out of my trade, because even though the market did not get here to 40.66, it got to 40.69, which is going to trigger a stop loss, right? You're not going to sit in this trade and wait for the market to slap you upside your head. You're going to go ahead and get out, right? So there is no point a put spread would have worked today, except for very, very late. Probably at this point right here, this is about 3:30 or something like that. If you had waited to place a put spread at 3:30, then that would have worked. But that's it. And we usually are placing our trades sometime before like 12 and 1 o'clock. So even given the latest at 1 o'clock, if we placed our trade, we would have placed it at 40.68, which again, the market got down to 40.69 and would have blown through whatever stops that we had. So today there just almost was no winning any kind of put spread today. If your game is to play expiration, and probably even if it's not, you probably would have been stuck in a put spread all day today, because there really was no lift to provide any profitability to any spreads. So you want to watch out for stuff like this. These days can happen. They're rare, but they can happen, and you have to be prepared to go ahead and get out just in case that happens, right? Most days are not going to be like that. They're going to threaten to be like this, but they're not going to continue on in this fashion. But sometimes they do, and you have to be ready for it. And I remember this day, there was no particular news or anything like this that happened on this day. This wasn't a FOMC day. This wasn't an inflation announcement day, or there was no news to really speak of on this day. It just was what it was that day, right? So you have to be ready for that stuff. But I want to make sure that I capture the fact that I trade my trades when I'm looking at 15 cents and 10 cents. Those trades are going to coincide with being two standard deviations and a little bit further away from where the market currently is. So these standard deviations change throughout the day, and they shrink and get closer to the market. But this line, as I follow this 2 standard deviation line is going to represent basically where 15 and 20 cent trades are residing within the market at that particular moment. So this is where we would place our trades if we were to wait for this particular time frame throughout the day. Okay. And I can show it to you a little bit clearly. I'll get rid of the VIX and I'll get rid of the expected move lines. So this is just a clean look at just the market pricing and the standard deviation lines, which again represent about 2 times the expected move. The expected move is basically represented by the 1 standard deviation line, and we trade at 2 times the expected move, which is about 2 standard deviations or a little bit further. Usually ends up being about 5 points or so above the standard deviation or below the standard deviation line where we actually place our trades. And what I'm looking for is for the market, I'm looking for throughout the day, I don't want my trade to be encroached upon by the 1 standard deviation line. So if I again use this day as an example, here's our 2nd standard deviation on the put side. So we would let's say we placed our trade right here at 40.98. If the 1 standard deviation line gets to 40.98 like it did right here, then I'm probably going to be exiting the trade or doing some type of damage control by this point. Okay. I'm not waiting for the market to hit my level. I'm looking for the 1 standard deviation to encroach upon my trade. That's when I'm looking to go ahead and do some damage control. Okay. So that's most of my trading strategy, the technical side of it. The other side of it is obviously looking out for news. I use Forex Factory's stuff to kind of see what news is coming up that day, so I know what I'm expecting, what times I'm expecting market moves, and I'm looking out for FOMC announcements and stuff like that. CPI announcements as well, but that usually happens before the market opens. So it usually doesn't happen during the market, so that's definitely helpful. I wish they would move FOMC announcements to do the same, but they don't. So anyway, that's my whole strategy. I don't think I have anything else. Oh, really quick recap. Looking to capture 25-cent iron condors. I leg into the iron condors based on market conditions. I use technical analysis to pick my entries, and you can see the results right here as well. You can see that here's all the trades that I've done over the past 40 days. I have them all kind of mapped out in here, and you can see they're all green except for this one I think January as well. But all of these trades have been successful, even on a day like this. This was a hair-raising day, but it was still successful. This is actually a FOMC day, so that's why that looks like that. And I picked the wrong side of the market, of course, and it still worked out. But I wasn't happy about it. But you can see all these trades are successful, right? So this trading style, I think, is very consistent. It works. It can be stress-free, although sometimes there is stress, especially when I break my own rules. But yeah, so pretty cool. It works on both sides of the market. It works bull markets, bear markets so far. And yeah, I like it. Okay. And just a quick blurb, since we've got a little bit of time, on the future of the trading. The whole point of doing this style trading is to compound. So right now we're at like $2,000. So the whole point is to get this number right here to get to 2,500 and then buy additional contracts at that point when we're able to do so. Now, like I said, as you get higher and higher, we're not using the full power of our contracts. And in this spreadsheet, I kind of account for that with the percentage profit. So even though this number says like 5 contracts, it only wants us to get $64 after commissions, and 5 contracts at the level that we trade is going to be more than that. So this is probably more like 4 contracts worth Yeah, actually probably 3 contracts worth of trading, about $75 before commission. So this is about 3 contracts, even though it's calling for 5 contracts. So if you want to follow this spreadsheet, you can either lower your contracts or lower your risk by doing maybe 20 cents instead of 25 cents, whatever you want to do, whatever's comfortable for you. But like I said, the whole point is to compound. So you can see this represents us compounding. And as we go further in time, you get these closer and closer together until they're back to back. And then you're compounding once every day. Then you start to take out money and you're still growing. And all of this is in an effort to grow responsibly, to grow consistently, and to not blow yourself up completely, right? So all of this is an effort to mitigate what risks are out there, why spread traders fail, why condor traders fail and leave trading altogether. You know, I've blown up a couple of accounts, and it's because I didn't take these measures to heart. And I already did a video about risk management when it comes to your trades, but this is risk management when it comes to your portfolio, so that you can grow responsibly, so that you can make mistakes and still live through it. That's what all of this is really about, because you grow so fast that you can recover from any small mistake. You can recover from any small mistake, but you can't recover from a complete blow up, right? So this is designed to keep your mistakes small at every level, so that you're never fully at risk. And it's designed to lower your risk as the money gets more significant, right? So you can see here, instead of 3%, we're down to 2.5%, and so on and so forth. And you can adjust this if you get into the room. But that's what all of this is designed around, is to mitigate everywhere that there's potential risk to blow yourself up, so that you don't decapitate yourself, okay, on a day like February 9th or whatever. And people have blown themselves up with super huge accounts and use this method to get their account super huge, and then blown all of that account away on, you know, one big mistake. So all of this is designed to keep you from having the big mistake, right? Is to keep your mistakes small, and account for all of that, so that if you get up to $160,000, and you're making this kind of money that, you know, particular day, and then the market has a black swan event or something like that, that at least if the absolute worst happens, you're not going to lose all of this, and you're definitely not going to lose any of this that you saved up over here. So you can blow up maybe half of this or something like that, and you can still start again and just back up a couple of days or weeks or whatever it may be, and then you can start from maybe 116,000 or something like that, and then get right back into the swing of things, instead of all of it going away, and then you're back to zero, right? That's what all this is designed to do. And one more point, I forgot to make this point, and I'm not even sure if I should do it in this video, because it's already long enough. Matter of fact, I'm gonna do it in the next video. So stay tuned for the next video, and then I'll make my point about the 1,000 trades theory. But that's it for this one. Have a good one.